On today's episode, we are going to take a look at IBM. They just reported earnings and they're down almost 3% after hours. So today's episode is going to be broken down to the following. First, I want to take a look at a recap of their earnings. Then I want to take a look at what I like about their earnings, followed by what I don't like about their earnings, some of the things that are throwing me the wrong way. And finally, I'm going to end with my thoughts. If you're new to my channel, if you're a long-term investor, and if you'd like to learn about growth stocks, make sure to hit that subscribe button. To all my returning viewers, thank you so much for the support. It truly means a lot. Like always, if you want to get in contact with me, YouTube comments, Twitter comments, you can find me on Twitch live streaming, on my Discord channel, which is free to anybody that wants to join, or at josenaharo.com. Everything I say here is just my opinions. None of this should be taken as advice, as I am not a professional. So make sure to talk to a financial advisor. Now that we got that out the way, let's get started. Before we begin, guys, don't forget to hit the subscribe button, the thumbs up. It helps the small channel out so much. I truly appreciate it. And let me know in the comments, guys, are you a bull or a bear on IBM? Are you purchasing right now due to this decline? What are your thoughts on IBM? It's always great to share with the community so others can see what our other investors' thought process right now. And finally, don't forget to hit that Webull link. Right now, it's on my pinned comment and also my description. If you sign up there and follow the instructions, we both could get a free stock, and that's pretty amazing, if I may say so. So right now, IBM, like I mentioned, is sitting at $121 after hours. Right now, it has a market cap of about $112 billion. So it's not the biggest company we've seen, but it's definitely a little bit bigger than the normal ones we see. Normally, we take a look at ones below that $20 billion valuation. So right now, IBM is a bit higher from there. So let's take a look at their most recent earnings. So they reported earnings today, October 19th of 2020. They did revenue of $17.56 billion. This is down 2.6% compared to same time last year. Quarter non-GAAP earnings per share were $2.58. This was in line with what was expected by the analysts. Revenue was also in line with what analysts were expecting. A few things that were pretty interesting on this revenues. First, their gross margins have increased from 49%. The overall consensus was 48.6%, and previous quarter was 48%. I do believe this increase of gross margins is due to the increase of revenue coming from the clouding business, and we're going to see that clouding business has very high margins, gross margin. So as that revenue increases, it's also going to help IBM with those gross margin increases overall. So if you guys have been following IBM, right, they are talking about separating the businesses into two. One of the business will focus on IBM's open hybrid cloud platform and AI capabilities. This, I think, is a pretty cool move that they're doing. It's one I'm very interested in learning more about, and we're definitely going to take a look at it in today's episode. One more thing I do want to say is I do believe this might be the second earnings or the third earnings with the new CEO. I want to say it's the second. So they are under new leadership. Krishna, I believe, is the new CEO. And I do believe this move of separating the companies might be one of the best moves they're doing right now, next to the acquisition of Red Hat. So now let's take a look at what I like about this earnings and the overall business right now. The first thing I like is on Monday, they did mention that thanks to the feedback from shareholders, IBM plans to maintain its dividends and grow it as the years progress. A lot of people were fearful that that might not happen. Next, IBM also announced the acquisition of WDG Automation, which is a Brazilian software company. And the main reason for this acquisition is to advance AI-infused automation capabilities for its enterprise. So it's an acquisition that makes sense, and that's something that I'm very happy to see. So we can see they're trying to strengthen their artificial intelligence and clouding capabilities for the enterprise world. So that's definitely going pretty good for IBM. Next, I want to say total cloud sales were up 19%. They're up to $6 billion right now. This is really strong growth. Even though last quarter was 30% growth, 19% is still very strong digits, any double digits growth. Next is cash from operating activities. This totaled about $15.8 billion with free cash flow of $10.8 billion for the trailing 12 months. Right now, IBM is still a cash money making machine. Even after paying dividends, even after paying debt, they still have $10.8 billion of trailing 12 months free cash flow. So this is definitely, it's not a company that's going to go down anytime soon. And like I said, with this type of free cash flow, it'll be able to do acquisitions like it's doing and continue to kind of experiment around the market to see where in reality it wants to go. Right now, we're seeing that it's really focusing in that clouding business. And with this type of money, it has that strength to go with it. I also like their balance sheet right now. In cash and cash equivalents, they have about $14.4 billion and they have about $1.2 billion of marketable securities. So close to $16 billion of quick cash available to them. They do have a nice amount of short-term debt, though, about $10 billion of short-term debt that's due in the near future. They also have about $55 billion of long-term debt. So they are very heavily in debt right now. But one thing I do like is, look, that deferred income is about $11.6 billion. That's money that will be coming in eventually. So I'm happy to see that really good. That deferred income will pretty much be able to pay off that short-term debt. But like I mentioned, right, like I previously mentioned, right now the cash flow for IBM is pretty great. Let's just take a look at these past 3 months. The change in cash has been about $2.3 billion. So right now we're seeing that, hey, even with that heavy debt, even with dividends, even with all the other stuff that they do, they're still improving their overall cash positions. This is telling me that this company is okay to be as leveraged as it is right now. Early on this episode, I did mention about this company creating two different companies. So it will be IBM and then the new company, they still haven't mentioned it. IBM will only focus mainly on hybrid cloud platform and artificial intelligence company. And I do believe that's a great move. That's right now, based on trailing 12 months revenue, will be about a $59 billion revenue company. The second company would be, they have no name for it right now, but it will manage the infrastructure, service companies. And that's going to be about a $19 billion company based on trailing 12 months. And here in this chart, we can see how cloud and software business is such a huge portion of gross margins. They have about 77.1% gross margin. So I do believe this new business will be pretty cool how they're separating. Right now, there haven't been any talks on how they're going to go with the shares, right? What I do believe is if you own IBM right now, you're going to have a certain portion of IBM, and you're also going to get new shares of this new company related to how this asset changes exchange. So that's something that's going to happen within those that are holding IBM. And they do mention that they are not expecting to do this until probably the end of 2021. So there's still some, I mean, this is a big thing, right? So there's going to be a lot of things to go over it, to look over things before this new separation happens. All right, so now that I mentioned what I liked about IBM, let me mention what I don't like about IBM right now. The first thing is, yes, even though they have free cash flow positive, and I mentioned this quarter was about $1.1 billion of free cash flow positive after paying all that debt, after paying all that dividends, and after all the expenses, it still had $1.1 billion. Right now, that is the lowest it's been since the first quarter of 2001. So that's kind of throwing a little bit of a red flag there. But remember, we are during this COVID situation right now. So it's something to just keep an eye out and see if it progresses as earnings come up. The second thing is IBM did pull its guidance for the full year in April, and as of right now, they still haven't issued any new guidance. And this is now quarter 3 of 2020. I mean, you would have expected after almost being at being 75% with the year, you would give some form of guidance for it, right? But at the moment, they haven't. Next, quarter 3 with this revenue down 3% compared to same time last year makes it the third straight quarter of revenue decline for IBM. This again, it's definitely a slowing down, but I do believe this is why they're shifting different companies. The new IBM, if this clouding market continues to grow, we'll start seeing that growth, and we'll continue to see that growth as years progress. Next, right now, IBM, as how it states, analysts don't expect too much for the company. They expect it to grow about 1% on average for the next 3 to 5 years. This is definitely not considered a growth company, but once things split up, that might change. The new IBM might be considered a true growth. The final thing I don't like about IBM right now is its 5-year chart, right? Usually in 5 years, if you invest, you would want your money to go somewhere. And in the past 5 years, it's actually down 13.24%. So if you bought in 2015, your money has actually decreased over time. Yes, IBM does have a strong dividend. Right now, it has a dividend yield of 5.1%, based on Google's numbers. I'm not exactly sure how true that is, but that's a really great number if that is true, right? And that might be kind of helping some form of investors right now if they purchased in 2015, right? Collecting that revenue over time. But seeing a 5 year chart like that is not something I'm too excited about. So now that we got that out the way of this earnings, I just want to give my overall thoughts. Right now, I do believe IBM that shifting in companies and making two businesses is a great is something that's very, I think it's very smart for management to do. I am liking right now how the new CEO is coming to the earnings call. I don't know if you guys knew, but the previous CEO, he did not make it to any earnings call, or he didn't even talk, which I thought was pretty weird. I'm liking this new leadership. I'm liking the move to the cloudy market, which is a market that I believe will continue to grow as the years progress. And by IBM making this shift, it means that they also believe this market is still one that will continue to grow. Um, so those are the main things I like, especially this company being a free cash flow making machine. This company is just making cash right now. So even though the debt is pretty leveraged compared to its cash, and that's something I personally would not worry as an investor. I do like their forward PE ratio of 10.36 and their forward price to sales ratio of 1.48. This is probably pretty cheap for a tech company. But why is it cheap? We also got to understand the negatives that are coming with this company. The first thing is this is definitely a slow grower right now. It's seeing revenue declines for 3 quarters straight. It's seeing a decrease in free cash flow as well. So it's definitely understandable for forward PE ratio and forward price to sales ratio to be this low. But I do believe if things get changed around, this can actually be a nice investment overall. So that's it for today's episode. Like always, make sure to subscribe, make sure to hit the thumbs up, and post on the comments. It helps the channel out so much. Take care, guys. Have a good night, and see you next time.